Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right. Today we're going to talk a little bit more related to portfolio performance evaluation. But actually, it's an independent topic. Basically, I'm going to talk about the cost of investing. So our today's lecture are going to be based on 4 finance papers. As usual, I post all those papers on the portal, but I don't require you read through it. You don't have to read through it. All you need to know is the material covered in our lecture about those papers, because I want to have some recent findings to shed some light about this topic, the cost of investing. It's actually a pretty important topic, but I don't know why our textbook didn't use a chapter to talk about this topic. So I want to cover this topic. So it's actually not in this chapter, but it's related. So the starting point is a question or a puzzle. We have already learned a passive market portfolio, like an index fund, SP 500 fund, so on and so forth. A market index fund produces a higher return than the aggregate of all active portfolios, right? So the index fund can generate high return. Why? This obvious fact, if you can recall what we learned a few weeks ago, one main reason is those active portfolios charge you all those fees, including management fee and marketing fee and all other type of fees. But index fund charge you very small, close to zero. And also because the index fund is already the aggregate, so there's no way that the aggregate of active portfolio can generate higher return than passive, because the passive one, they are same thing. A passive one, just the average of everything, including active plus passive. So that's the average of everything. So by mathematical definition, it's impossible to have active portfolio much higher return than a passive portfolio, right? Is that clear about that? I think if you are still not clear, just check what we learn in the lecture 8, okay? So in other words, the active investing is a negative sum game. So among all those active investors, they are playing a negative sum game. Why? If there is no cost of active investing, if there is no cost before considering cost, then it's a zero-sum game. Why it's a zero-sum game? Some active investor gain, some other active investor loss. What I mean loss doesn't mean you generate negative return. Just you compare with the index return, you got lower return, that means you suffer a loss. If you get a higher return than the index, then you learn a profit, okay? So if there is no active cost, then it's a zero-sum game. Some investors will above the market return. Some investors would below the market return, but it's a zero-sum game. However, there is significant cost, fees, expenses, and trading costs. Then that means all those active investors are actually playing a negative sum game. On average, it's below the index return. So the average is already below. So that is called negative. That is why it is called negative sum game. So if this game looks so bad, the question is why active investors are still in this game. That's actually a great puzzle in finance. It's not really a trivial thing. Why? Let me explain why this puzzle matters a lot. Because the question is, if that active investing is such a negative sum game, is so bad, the question is there any benefit of doing active investing? Is there any benefit? The answer is yes, huge benefit. Huge benefit. What's that benefit? The benefit of active investing is price discovery. So which means all those active investors collect information, and by doing trading, the market absorbs the information those investors collected. Once the market absorbs all those information, the price became more accurate. So which means improve the accuracy of financial prices. And if the price is good, the price is accurate, that would improve our society's allocation of resources. That's the ultimate purpose of economics, right? A better allocation of resources. So that is why this benefit is huge. At the end of the day, this allocation of resources depends on those active investors to collect the information and to do trading, right? However, this huge benefit is, in economics, it's called externality. Externality. So what is externality? It's a positive or negative consequence, economic active experienced by unrelated third party, which means all those, why we call that third party? Because there is a huge benefit to our society, not the huge benefit to investors themselves. You understand? They are trying to collect the information. They are doing the trading. At the end of the day, the price became accurate. That will benefit everyone else in our society, but not those investors themselves. For the investors themselves, they still suffer something called a negative sum game. They still suffer. other people in the society benefit. So this is a puzzle, right? Because those people are not really the nice guy. They are selfish people. They do things for their own benefit. But the true effect is actually they contribute to other people in our society, and everybody benefit from their activities. Then, in other words, if you recall Hayek 45, in other words, the activity of those active investing just makes the price system as a better mechanism to communicate information, because this is the primary role of price system, right? And how to make sure price system do a good job to communicate information, you need those active investing, right? But in the end of the day, if this is a puzzle, because if those active investors realize that they are actually in a negative sum game, would you continue to do this active investing? Maybe they would not. They should not. If they will quit this activity, then they will not provide benefit to our society. Then what happens is the price discovery is in trouble. Then at the end of the day, the price system cannot be a good mechanism to communicate information anymore. That's a huge bad consequence, isn't it? So that is why this puzzle matters. People want to ask, okay, this game is not good, but why your guys are still in this game? Why you don't just leave? Okay. So first, so we're going to talk about this topic a bit today. But first of all, I say this is a negative sum game. How negative it is, we need quantitatively to pin down, right? It's a bad thing, but how bad in terms of numbers? So this is a central question of French's paper. This is formal French, and his paper is just looking into the true data and computing the cost of active investing. So this is not this. Those investors suffer cost, but how much? So the methodology is he compares how much do investors pay to trade. This is active investor, how much they pay just for trade. With if all investors switch to passive investing, then how much would they pay? Because passive investing, it's not completely free. It's a tiny little bit cost. Then the difference between them would be the cost of active investing. That's straightforward, right? Active minus passive, that's difference is the cost. If everybody switch to passive, then how much cost they can reduce? That's the central question. So this paper is not a theory paper. It's just looking to the real reality in the US and try to generate a simple picture. So we just focus on this table, 2 tables and 2 figures in this paper. With the first table 6, this is the cost of active investing. There are 4 components. 4 components in the paper use different colors. 4 components is called institutional costs, this one, and fund fees and expenses to the mutual funds, and trading cost. When you do trade, you pay financial intermediary the trading cost, and the dark black is hedge fund fees. Right? If you do active investments through hedge fund, you pay hedge fund fees. Right. So this is basically, in this paper, institutional cost typically means if you are invest to a pension fund or public fund, and so or non-profit institutions like universities, endowment fund, so on and so forth. So a very striking feature is along all those years, over the past 40 years, no, not 40 years ago to 10 years ago, the total cost of active investing is strikingly consistent. It doesn't go up or go down. It's roughly between 70 basis points per year to 80 basis points per year. So if you are not familiar with basis point, this unit, it's very widely used in finance. 1 basis point equal to 0.01% in terms of return, okay? 1 basis point, 0.01%. So roughly 80 basis point as a cost, that's 0.8% per year, right? 80 times this 1 basis point, that's 0.8% per year, close to 1% per year, right? That's a cost. You can see the individual component has some long-term trend. For example, this corner means the trading cost. The trading cost shrink a lot from 40 years ago all the way to 10 years ago. It's still shrinking today because of technology advances. The trading became easier and easier, but this component became larger. That's mutual fund expenses. And those institutional costs become smaller, and hedge fund cost was not there 40 years ago, but in recent 2 decades, it was there, hedge fund fees. So in terms of numbers, this is just the numerical version of that picture. It's the same thing. If you're curious about just numbers of all those years, from 1980 all the way to 2006, the cost of investing, so this is every year the basis point, so it's largely constant over time. Then this is the cost of active investing. What's the cost of passive investing? Remember, the next thing we want, French want to figure out what's the cost of passive investing. And this column, the same year, over the 40 years ago to 10 years ago, and also in the unit of basis point. You see, in recent years, it's less than 10 basis points per year. That's less than 0.1% per year. So this is 0.089% per year, right? Almost 9 basis points per year. So remember, we are looking for their difference between this cost and that cost. And this is a difference. This is a difference. This is actual cost minus passive. So this is the whole thing about the cost of active investing relative to passive investing. And also you can more straightforward to look at this cost in this graph. This graph shows the difference between the actual and passive cost of investing in terms of in the unit of basis point from 1980 to 2006. And on average, this is 67 basis points per year. So over those years, the active investing cost investor 0.67% of the value of the market each year. Right? So this is a number. So probably you don't have a sense. You think this is not a big number, right? Just 0.67% per year. It looks small, right? But remember, this is 0.67 per year of the aggregate value of the market. What's the aggregate value of the market today? $25 trillion. $25 trillion, right? It's a huge money. If you can do, we can do a simple calculation, very simple one. So what's the market cap today? Market value in the US, let me get it a little bigger. Is that better? Okay, market value is, say, $1 trillion. Let's use T. Trillion is how many billion? This is billion, right? And, okay, then the fees are charged by the costs. The cost of active investing is equals this amount of money times 0.%, that's 0.0020, right? 0.67%. So this is this billion. So almost 170 billion per year as a cost. Who learned those costs? Where does this amount of money go? Largely go to the pocket of those active, the mutual fund managers, mutual funds, employees, and there are other operating fees. But a large portion of those, this amount of money go to the pocket of those employees in this industry, right? Suppose half of them become salary. Suppose half of them become salary. In this industry, let's assume that just half of those money become salary. Then all those people can learn almost 100 billion. How many people you can hire with this amount of million, with this amount of money? Suppose, on average, each individual worker in the finance industry learn, say, 0.1 million per year. That's an individual salary, right? Okay, so this divided by that. Because it's billion over million, then times 1,000. Is that correct? So this is roughly how many? Roughly 1 million employee, right? This is 0.8. This is very rough estimation. So this is how many workers you can hire. So 1 million finance workers just depends on this cost. 1 million, that's a huge number. Because the total employee in the financial sector is just several million, 4 or 5 million. So this is almost 1 million. Depends on this 0.87% per year. A lot of people, their job depends on this. They learn a lot of money depends on this 0.67% as the cost of active investing. Remember, is there a rational basis for the existence of their jobs? No, it's a puzzle. remember, why should those people exist? Because they are playing a negative sum game. Aggregators are losing people's money. Of course, they contribute a lot of benefit to the society, but it's third-party contribution. So they are losing money. Okay, so the question is why those people are still in that game. French actually provides some possible explanation. That's not definitely the answer, just some possible explanation to answer the question, why do those active investors continue to play this negative sum game? The first possible explanation is that those investors have misperception about investment opportunities. So specifically, many investors are unaware that average active investors would increase his return if he switched to a passive strategy. So they just don't know that if they switch to passive strategies, they can have a higher return on average. This is a simple fact, but many people don't know. So unaware of that. Another point is, this is very interesting. The general message from Wall Street is that active investing is easy and profitable. And this message is reinforced by all those financial presses, which offer a steady flow of story about undervalued stock and successful fund managers. So this is more like a conspiracy theory, right? I mean, it's not really a conspiracy theory, but the Wall Street want to defend their job, defend their role, right? So they can consistently provide some story about very successful superstar fund managers, and also story about there are a lot of undervalued stock in the market. So if you really believe this picture, you will believe that active investing is very easy and profitable, but this picture is simply wrong. It's sort of misleading. So it's, in Trump's word, it's just fake news, right? It's just fake news. Not only in politics, but also in finance. All right? So, but this fake news just leads general misperception, right? People just don't truly understand what is going on there. So this is from the, this is just investors don't know. Another reason is investors know, but they are overconfident. They know this thing, and they don't believe this story, but still, they are overconfident people, which means investors who are overconfident about their ability to produce superior returns. So they are unlikely to be discouraged that this active investor lose on average. So the point is, I know that on average, active investor lose, but I think I am far above average. So if I think I'm far above average, then I don't care about average lose or it doesn't lose. But if a lot of people think this way, then many of them must be wrong, right? You cannot everybody above average, right? If majority of people believe they are above average, then many of them must be wrong. And they are just overconfident. So these are two possible explanations. One is people don't know. Second is people know, but they overconfident. Okay. I take a Then I talk about another interesting puzzle by the second paper by Puzzle and Verdieu, published on Journal of Finance roughly 10 years ago. The central point of this paper is the relation between price and performance in fund industry. The main finding is this paper found another puzzling fact. The fact can be summarized with one sentence. Funds with worse before fee performance, charge higher fee. Typically, if you do a good job, you charge higher fee. If you do a bad job, you charge lower fee. That's what it should be, right? But this paper found those funds with worse performance, but those funds charge relatively higher fee than the rest. So a little bit specifically, in theory, the service provided by fund is just to do portfolio management, right? This is like service. As investors, you pay fee to those funds just as purchasing the service, right? You purchase the service, you pay fees. So in theory, fee should reflect the fund's performance, right? If the service is better, you pay more. If the service is not good, you pay less. In theory, it's very straightforward. But, so this should be, in theory, should be a positive relation. But this paper found a negative relation. Funds with worst performance charge higher fee. So this is straightforward, just single graph to show the negative relation between the fee they charged, the horizontal axis expense ratio. Remember what's expense ratio? That's the total expenses over the value of your portfolio, right? It could include management fee, marketing fee, and other all related expenses charged by the fund to investor. So the higher expense ratio means higher fee. And the vertical axis is alpha. In this paper, they use 4-factor models, alpha. Remember, every time we talk about alpha, we need to specify this is 1-factor alpha, 3-factor alpha, or 4-factor alpha, so on and so forth. In this paper, they use 4-factor alpha, which is formal Francis 3-factor plus momentum factor. So alpha means performance. Expense ratio means the cost or the fee. And obviously, this is a negative relation. Negative relation, and zero is zero alpha. You can say majority of this font, this blue curve, is below zero, right? Zero is somewhere here. And what is this dashed line? This is 98% of fund is within this range. Only 1% of funds on the left and 1% of the funds on the right. So of course this is extreme case. There are a little bit strange things happen for the extreme case. But for the rest 98% of all those funds, it's clearly a negative relation, which means performance is bad, but you charge higher fee. And performance is good, you charge less fee. So this is another puzzling fact, simply a fact. So, and also this, the author provides some possible explanations, right? There are 3 points. The first point is those mutual fund investors differ in their performance sensitivity. I'm going to explain what does performance sensitivity mean. So some investors are performance sensitive. They are sophisticated. Those investors will have fleet underperforming funds. So what does performance sensitive means? If my fund do a bad job, then I will withdraw all my money and switch to another fund. Every time I observe that, I will fleet underperforming fund. If I can do that, I'm a sophisticated investor. So I'm a good investor, experienced. So therefore, for those underperforming funds, will have a great proportion of performance insensitive investors or unsophisticated investors, which means sophisticated investor will run away from bad fund. only unsophisticated investors stay with those bad funds. You see that picture? And because all those bad funds have only unsophisticated investors, they will charge higher fee because no matter they could increase a little bit fee, but because those investors are not smart enough, they are not sophisticated, so they still don't flee away. So this is something like you have some customer, those customers are not smart, they are dumb. Then you can cheat them by charging higher fee. They don't know, they still stay with you. So this is a story like that. Another story is very similar, very similar to the first explanation. Underperforming fund can't compete with those high-performing funds. For smart investor, let's use smart, okay? Because they do a bad job, high-performing fund do a good job, so you cannot compete with those. So all the smart investor will go to high-performing fund. Then the underperforming fund will target those unsophisticated investors, then to charge higher fees. Those two stories are very similar to each other, but what's the difference? The difference is, in the first story, just the smart investor run away from you, so you can charge higher fee to the rest. The second story is, at the beginning of the day, you just target those unsophisticated investors. You just target them at the beginning. So you just give up. I don't want to target those smart investors. I just target those unsophisticated investors so I can take advantage of them. The third explanation is those underperforming funds will have higher advertising cost, which is also called marketing cost. And those unsophisticated investors are more responsive to advertising because they are not smart enough. They are more likely to be attracted by advertising. Then if you are not a good fund, if you're a bad fund, you can spend a lot of money to do advertising, then still you can attract those unsophisticated investors. And of course, those marketing charge will pass to the investors as higher fee. So if you go through all the 3 points, basically the basic reason is all those bad performing funds are trying to take advantage of those dumb investors. If investors are dumb, you got be taken advantage by those bad funds. So you have to be a smart investor, right? Otherwise, this is like a jungle. You will be a prey, and there are predators found there. And let's move on to another paper. Another interesting point about performance of mutual fund is that this paper by Groucho and Reuter, they find that funds marketed directly to retail investors don't underperform index fund. In contrast, those funds sold through brokers significantly underperform index fund. So index fund is a benchmark, right? Aggregately, active fund is worse than index fund. But this paper says it depends. It depends on what kind of active fund. There are 2 types of active fund. First type is called the funds marketed directly to investor. The second type is called funds sold through brokers to investor. So in other words, this fund industry, this market is segmented. And there are 2 different types of investors. The first segment of this market is called direct sold, which means the fund market directly. to those investors. Typically, those investors are experienced, sophisticated investors. And another segment is called broker sold investors. So you need an intermediary to first through a broker, then find your ultimate investors. And those funds sold through brokers or financial advisors, typically those investors are less experienced investors. So there are two segments. So in the first segment, because investor flows are more likely to respond to fund performance. Because why? Because in this segment, there are experienced investors. If you do a bad job, then people just stay away from you. If you do a good job, then the money flow to you. Then, so because this investor flow will give strong incentive for those fund manager to generate alpha. Generate alpha means to perform. But in the second category, in this broker sold segment, the investor flows are less responsive to fund performance. Less responsive means no matter your performance is good or bad, those investors are still dumb. Which means if that is the situation as a fund manager, you have a much weaker incentive to generate alpha. You don't care because your investor doesn't care. So why should you care? And they have some numbers to show. So we just focus on the three column 1, 2, 3. So this is let me explain what those numbers means. This is in this table 6, same paper. The column 1 means index fund outperform active managed fund by on 7.3 basis point per month. That's 87 basis point per year. So in this paper, this number is a little bit higher than French estimation, but close, because every paper has different numbers. So aggregately, index fund is better than active fund. So this is what we already know, right? This is what we already know. This is 7.3 basis point per month. So what's the column 2? The column 2 is the outperformance of direct sold index fund. Remember, one segment is called direct sold. Direct sold index fund relative to direct sold active fund is only 1.8 basis point per month, and it's statistically indistinguishable from zero. So this is here, which means the difference between active and passive is much smaller. Passive is still a little bit higher than active, but this number is much smaller. But importantly, statistically indistinguishable from zero, which means statistically insignificant. So which means if you are in the direct sold segment, then index fund and active fund basically has similar performance. No big difference. They are basically the same. But the column 3, another segment called broker sold, then broker sold index fund relative to broker sold active fund, the difference is huge. The difference is 0.0893% per month. So the difference is 9.3 basis points per month, more than 100 basis points per year. So in this segment, the difference between index fund and active fund is huge. Index funds outperform active fund a lot. So the story is aggregately, active fund do a bad job, but that's mostly because this segment, broker sold segment, the difference is huge. If it is direct sold segment, then there is no big difference between index fund and active fund. So that's an interesting story. So finally, I just have one page to go. Right. I want to have a recent paper by some Giuliani and Schleifer and Washley. Has a paper 3 years ago. The title of this paper is interesting, very short, just called "Money Doctors." This is the title of this. Probably this is shortest title I ever see in financial article. Just 2 words. Money Doctors. Why they can publish a paper with just 2 words as title? Because this guy are chair professor at Harvard. Of course they can publish what kind of article they want. And basically what the main point of this paper is, investors delegate portfolio management to professionals based on trust rather than seeking superior return. That's the main point. This word trust. But trust is a very ambiguous word, right? What does trust mean? Well, this paper really mathematically defines what trust means. It said trust provides investor a peace of mind, reducing the investor's anxiety about taking risk. So this is more like psychology doctors, right? So provides just peace of mind, make you feel better in taking risk, okay? Because this is a service, so this is very much like similar to medicine. So investor trusts their money manager, just like patients trust their doctor. So if you go to a psychology doctor, then it's just about the doctor provides you some advices, help you feel better, then you pay them fees as for their services. So this is a story to tell you why the active funds have bad performance, but still active investors stay with those funds. The reason is fund manager can provide you peace of mind, and index fund cannot provide you that. Do you see the difference? Because, but how to mathematically model this trust? Because the reasoning is straightforward, but mathematically how to remember, this is utility function, right? Utility function is positively related to return and negatively related to risk. And the capital A is risk aversion. Originally, we assume that risk aversion, the capital A is fixed for each person, has a fixed risk aversion. Maybe your risk aversion is different from my risk aversion, but for each individual person, risk aversion capital A should be fixed. That's what we learned before. But in this paper, they just say, no, it is not like that. Your risk aversion depends on what kind of fund manager you are dealing with. If you are dealing with an active fund manager, you feel better because this active manager provides you peace of mind. Then if you feel better about risk, then your risk averse, this A would be smaller. You will not fear taking risk. So your risk aversion will become smaller. In contrast, if you are doing with a passive investment, there is no fund manager to provide you peace of mind, then you will fear taking risk a lot. If you fear a lot, then your risk averse will become much larger. So the red color risk aversion will be much bigger than this blue color, even for the same individual. For the same person, your risk aversion will depend on whether you have an active manager to help you or not. So by this way, because the active investors can give you a smaller A, remember this is a negative sign here. Smaller A means a higher utility, right? Smaller A give you a higher utility. So you got a higher utility, you will pay fee for having that higher utility. So that's a reason why active investors want to pay fee for those fund manager, even if the performance captured by this return, even if the performance is a little bit worse, but still